All right, welcome everybody. It is good to have you here. I see Chuck, I see Sam. Good to see you guys on the camera. Again, good to see you. We are ready to roll here on this session of the PFP alum program. And the topic today is, again, tax tips your accountant never told you about. Now, we're going to walk through a number of different items in here. Now, one of the things to keep in mind is if you've got your PFP manual, we're picking up on roughly page 139, according to my note. It is, so we have the section. So a lot of the stuff we're covering in here is in the book as well. So we're literally picking up in that section for the live classroom. So that's where we are. And a couple of different things about the session. All right. So I know we've got a couple of you in here. One of the things that we do for the PFP alum sessions is, again, we tell everybody to go ahead and register, whether they know if they can make it or not. And so even for those of you who are here, know that we record this. That's the intent of it. So again, that's why we tell them, even if you don't think you can make it, we'll record the session and we will send out a link to everybody who's registered afterwards in the session itself. So we've got a number of people who we may have some popping in here along the way, but we have a number of people who registered just to get the link for the recording. So we are good with that. That's the intent of this. Now, again, with all of these live sessions, we want to make this as much like a live classroom as we possibly can. So feel free to ask me questions. You can, unmute yourself and ask the question or use the chat box. I'm good with that. I've got a chat window right here in front of me, and so we'll utilize that. Now, again, we've all been in Zoom meetings enough over the last 4 years, but a couple of items. We do have everybody muted as you come into the room. It's not because we don't want to hear from you. It's simply because we know that you can't always control the sound levels in your background. So feel free at any point to unmute yourself and ask a question. Interrupt me if you need to. That's okay. We're good there. And the other one is, again, you can just unmute yourself. The other one is the chat window. If you have a question or a comment, feel free to just put that in the chat box. Again, I've got the chat window right here in front of me, and so I'll see those questions come in, and I can answer them in real time as we go through that. So that kind of gets the foundational stuff out of the way. And really, our objectives today are hopefully, number one, lowering your overall tax burden by using the benefits of incorporation, finding additional deductions. We're going to talk about some of those items, shifting income and rental dividends and rental income, looking at how can we increase depreciation, using your kids as a tax deduction if you're in that stage of life, and then understanding some audit triggers that are going to kick in there as well. Now, one of the other things is, again, we're dealing with contractors across the U.S. and Canada. And so if there's one of these items, first off, I know you're doing some of these already, right? You should be. And so if those are things you're already doing, awesome. If not, jot a note down on them. I am not an accountant. I don't play one on TV. I don't even play one on Zoom. And so, if there's something that kind of makes sense for you, jot it down. And what you want to do is you want to go talk to your CPA about it and to say, hey, does this make sense to me? Does it apply to me? How can I leverage this piece of the puzzle? So that's really what we're looking to do as we go through the program itself. And so with that, let's jump right in to some of what we've got going on. And the first one is really how your company is structured, how you're set up from a business standpoint impacts what you end up paying in taxes. All right? And so if you as a company are self-employed, you're a partnership, quite frankly, you pay more taxes than any other company out there. And for that, the rest of us appreciate it. Thank you very much. And so, if you're incorporated, it does help you. There are benefits for you in that piece of the puzzle. Now, whether it's a full C Corp or an LLC, right, there are some benefits in terms of what you can do and take for write-offs in that one. There's also a couple of items to keep in mind. Number one, if you're incorporated, an LLC, whatever, technically you have to have an annual meeting every year. Right. And at this annual meeting, you're going to talk about whatever it is that, again, you're reviewing the year, where your strategies as you're moving forward, whatever that case is. Now, that annual meeting can be held anywhere in the continental 48. You need to take some kind of minutes for it and technically have that in your business documents. Now, here's the thing. That meeting, again, can be handled anywhere in the country. And so the travel to get to the meeting is a company expense for your family. My company meeting tends to happen in Florida every year, right? And so we go down there, right? When the kids were younger, there was probably a visit to Mickey in there somewhere, right? Otherwise, now it's more a condo, and somewhere in there, right? My wife and I are going to have a conversation on some of the stuff we do within the company and where we're looking to go, right? It's certainly not formal, but when I get back, there are always minutes for that meeting that took place that go into the file, right? By doing that, the cost of travel for that trip now becomes a write-off for the company. Right. And so we can take that as a write-off. It is a valid expense. For the company, your corporate offices can be anywhere. Right? Not just in the Continental, it can be anywhere. Right. So for some, depending on your company, and again, we work with a lot of different size of companies. For some, the corporate office can be your home. Right now, with that, you do need to watch a couple of different items, right? Because it does open the home up for deductions, but technically the deductions are based on square footage. So for example, a number of years ago, before we started renting this space that we're in, 15 years ago or so, our corporate offices were in the lower level of my home. So literally, I had employees that came to my home, right? They went into the lower level. That's where we ran the company out of. At that point, it did open the home up for deductions. And literally, our offices were 18% of the square footage, the total square footage of the home. That meant that there are a number of different expenses that we had that were deductible at 18%. Right. So in our case, certainly in winter, we had to have room for parking and that stuff. So clearing the driveway, having the snow removal in the driveway, I had somebody come in and take care of that. So I didn't have to be doing that before employees started getting there. That was deductible at 18%. The utility costs, quite frankly, 18% of those were a write-off, right? We could do that. Now, with that, there's one other element or things that you need to be aware of, right? So with the corporate office, right? So let's say we did something, and again, what you can take as a write-off, you need to be careful of, right? Make sure that you're staying clean with it. So, you don't want to depreciate the entire house, because if you do that, now you lose the $500 deduction that you get for profit every 2 years for capital gains. You don't want to lose that piece of the puzzle. However, for example, if I painted a room down in the offices, that's a 100% deductible. Right? Put new carpeting down in the lower level, right? Because that's our offices. That's 100% deductible because that space is only used for the office. If I painted the outside of the house, on the other hand, that's a different story. That's 18% deductible. And if I deducted the entire thing, then again, we're right back into risking the capital gains piece down the road, right? So be careful there. Now, the IRS has tightened this up a little bit, right? Because, at one point in time, you could say, well, again, we've got the spare bedroom upstairs. And so, we're always working at the coffee table or wherever it is, a kitchen table, doing some of the books or doing some work. And so we can make that the home offices. The IRS has definitely tightened that up over the last number of years and said the space that you are claiming has to be used only for this purpose, right? So literally, we would have companies who would have, we got the office upstairs, and that's the office, right? It's a spare bedroom that's now opened up, but mom's also got her sewing machine in there and does some crafting and stuff like that. That immediately, it's no longer available. It's no longer a corporate space. That's just personal living space that you're using to do office stuff for it. So again, make sure that you're staying clean with that stuff. They do state that if you're claiming personal home space or home deduction is office, the only thing it can be used for is office, nothing else. Right? So stay clean there. Right? But it's certainly doable for those of you who are doing work out of the home. The second thing is that, again, you can have different benefits for different corporations. And so again, depending on the size of the company and what you're doing, the law says benefits offered to one employee must be offered to all employees within the company. And so there's nothing wrong with having two corporations, right? Corporation number one tends to have our technicians and our office help in it. Technician number 2 basically has you and your family in it. No, by the way, corporation number 2 just happens to pay all medical, dental, and education costs for all employees in the company, right? That could be done. And now what's happening here is literally corporation number 1 is hiring number 2 to run the company, is what would be happening there. So that can definitely be done. Also, different corporations can be a benefit for you from a liability standpoint. So there are a number of companies where, in fact, I used to work for a wholesale distributor. We did this very same thing. You put a second corporation for all of your vehicles because that now insulates the main company. If one of my employees goes out, totals a vehicle and kills somebody, right? The exposure is the corporation that has the vehicles in it, not the rest of the company, right? And so we can look at that piece of the puzzle, and so we can limit that. In our case, as a wholesale distributor, we had several vehicles that our territory managers drove. We had semi-trucks for delivery. All of those vehicles were in a separate corporation, and then the main company basically paid the other corporation for the use of the vehicles is what ended up happening. We were leasing the vehicles back from them. And again, it insulated and you know, as things happen, right? We had a situation at one point where we ended up with actually 2 situations. One where we had a individual who got into an accident. Wasn't their fault, but there was a fatality in the accident. Anytime that happens, right, in today's litigious society, somebody's going to get sued. Our pockets were certainly deeper than the pockets of the individuals who were involved in the accident, and so it opened itself up there. The other situation was an employee who, driving a semi-truck, blacked out and literally ran into this, rolled over the semi. Now, by the grace of God, there were no other vehicles on the highway, but had there been, there would have been other major issues there. So that can protect your company from a liability standpoint by doing that. Also, this one should go without even stating it, but unfortunately I need to state it because I see it all the time, is, again, credit cards. Use separate credit cards for personal use and corporate use. Do not mix personal funds and corporate funds together. And again, interest for personal use, interest is not deductible. Corporate use, interest is deductible. And if you start mixing both personal and corporate expenses on the same card, or out of the same bank account for that matter, all of a sudden that's commingling of funds, and the IRS gets really jittery about that, and that will create some problems for you. The same thing I see all the time where smaller companies, where maybe the company is making the house payment for the owner. Well, then you have to ask the question, then who owns the house? Is it the owner or is it the company? Right? And so keep those funds clean, because that can create some issues. Even if you're a sole proprietor and everything flows to you personally, it just makes sense to keep those accounts clean, keep them simple at that point, so we don't run into issues with audits down the road. So that one should go without saying. Your auto expenses. Every one of us ends up having somebody use a personal vehicle to run a company errand. Right? Whether it's, in my case, in fact, just yesterday, my wife ran to Costco to pick up some supplies here in the office. Well, at that point, technically, that trip is a deductible expense. Even if she made other stops along the way, right? She had 5 other places to stop, but that trip, now the mileage becomes deductible. All you need to do is to be able to do that. Anytime mileage is put on a personal vehicle, all you need to do is to simply keep a record of it. Can be nothing but a simple little notepad that you keep in your pocket or keep in the glove box of the vehicle. And every time you make a stop for the company, the mileage for that trip can just simply the date, you log where you stop. That's all you need, right? And the nice part is for 2024, the allowable mileage is 67 cents a mile. So think about it. If over the course of the year you put on 2,000 miles, that's a deduction of $1,340 that you can take at the end of the year. I look in my case, I do a fair amount of traveling. Every time I go to the airport and back, with my personal vehicle, that's a deductible expense because it's for company purposes. And so, again, whether it's a trip to to Costco, a trip to the supply house to pick up a part, have them run out to a job to deliver a part to somebody, all of that stuff is deductible. Now, that rate, 67 cents a mile, is for 2024. It changes every single year depending on the cost of fuel and the cost of inflation and things like that. And so that's usually updated every December. But it's surprising how fast those miles add up. I mean, I looked at it last year when we went through, and I typically never had recorded the stuff I did to the airport and back because I live literally, 13 minutes from the airport. And when I looked at my miles last year, it was several thousand miles that I put on back and forth between the airports. So it adds up quickly. Take advantage of it. Again, it goes right back to what is the silver bullet to profitability? There is none, but there's all these little tiny BBs that save me money here, save me money there. So we take advantage of them. The next item then is dividends and rent. Now, when we get into dividends and rent, there is no Social Security or Medicare taken out for money that for the owner that they receive in the form of dividends or rent from the corporation. All right. So in this particular case, let's talk dividends or distributions for a moment. If you take out distributions out of the company as the owner of the company from the corporation, there's no, again, Medicare or Social Security taken out. So when you think about that, that's 7.65% for you as the employee and 7.65% for you as the employer. So 15.3% is saved. And so literally, if you reduced your income, your salary by $20,000 and instead took $20,000 as dividends or rent, you would save at that point over $3,000. 15.3% of the $20,000 would end up being a savings for you. Now, there are, so let me hold on to that one because there are some requirements that the IRS is going to look for on that one. On second hand, let me hit that one right now. So when we talk about dividends or distributions coming out of a company, there's two elements to think of. The first one is, if you remember when you were in the workshop, we talked about the owner's salary and what you put in for the owner's salary. And again, my opinion on that is always, if you typically take out dividends, or if you would like to take out dividends, then you need to add whatever that dollar amount is into the salary that you have entered in for you in the software. Right? So let's say you're taking out a $100,000 salary and you want to take out another $50,000 in dividends. Well, then I would actually enter your salary in the software as $150,000. And the response I always get is, well, wait a minute, Bill, we don't take out the distributions unless there's actually profit. Well, that's exactly right. Remember, we're trying to tell you what your labor rates need to be to cover your cost of operation and generate the profit. And if we don't plan on there being distributions there won't be any. And so I want to add that cost into the company so the hourly rate that we come up with will generate that profit target to enable me to take that $50,000 out of the company. So that's the first one to keep in mind with regard to the software and dividends. The second one is, I've had plenty of companies that, owners that have now said, yeah, I really don't take a wage. I just take out chunks of cash and it's dividends, and that's what I do because it saves me money, right? The IRS says, they state very clearly, it's not a hard and fast rule, but the guideline is very clear, is that, number one, as the owner of the company, you need to pay yourself a real and reasonable wage. You can't just take everything in the form of distributions because, oh, by the way, they're not getting their Social Security and Medicare, right? So you need to pay yourself a real and reasonable wage for the job that you're doing. And then second, a general rule is that you can't consistently take out more in dividends than you do in wages, especially if they think that you're not paying yourself a real and reasonable wage. Right. So now, again, that one's not hard and fast because they're going to look at it over time. So I leave that one up to, and for years, right, I'd leave that one up to my CPA, right? I'd take the money out And they would then go back at the end of the year and say, okay, this year we're going to have, maybe it's 60% of whatever you took out is going to be wages, and the other 40% is dividends. And the next year it might be, okay, this year it's 45% is wages, and the remaining 55 is dividend. Right? They're going to kind of maximize that for me. And your CPA can definitely help you with that piece of the puzzle. But keep in mind, unless, now once you get to the point where you are paying yourself a real and reasonable wage, then the distributions can start going up at that point in time. The other element when it comes to the distributions or dividends is the IRS reserves the right to reclassify anything you take out as wages at their discretion. So if they don't feel that you're taking enough out in wages to be considered a real and reasonable wage, they will literally reclassify some of your dividends as wages. And that means that, oh, wait a minute, you didn't take out Social Security and Medicare, so now you owe that. And oh, by the way, now since you're late on that, there's a fine that you need to pay on it, right? So again, keep yourself clean in that case. In a lot of cases, for a lot of companies, if you're just pulling money out of it, then what ends up happening is at the end of the year when your accountant does your taxes, is they go back and they say, okay, the wages out of all the money, let's say just for easy numbers, you took $100,000 out of the company. They're going to say, okay, out of that $100,000, $100,000 is wages, which means the company matching taxes that we have to pay are X amount, right? And then the fine on it because we didn't pay quarterly or deduct it from the check, right? And then everything else is dividends, right? So they're automatically doing that in a lot of cases on your taxes for you to keep you out of trouble. So that piece of the puzzle is certainly there. You need to decide how much risk or how much you want to deal with this. In the early days of Grandy, that's exactly what I did, right? I just pulled money out of the company. My accountant would kind of even it out at the end of the year. And then they'd come back to me and say, hey, you actually had a pretty good year this year. Here's, you owe $25,000 in taxes. And I'd find myself every March stressing over, okay, how am I going to come up now with, I got to come up with cash for $25,000. And I ultimately decided for me, right, is I didn't need that kind of stress in my life. And so I literally changed. I pay myself as an employee of the company, just like every other employee of the company. And I pay that real wage to myself. There's taxes deducted every payroll, just like there are for every other employee. At that point, I get to the end of the year. I still typically have to pay in, right? Because I'm an LLC, all the profits for the LLC flow to me personally. And so for whatever profits there were in the company, I'm still paying it, but the dollar amount is a lot less. And again, my hair doesn't go gray nearly as quickly as a result of that. So again, I just happen to like that process a little bit better. So that's the first piece of the puzzle, dealing with dividends and rent. And again, if there's any questions on that, feel free to throw those out. I'll answer them to the best of my ability. The second one then is rent. Now, rent, same thing applies. No Social Security or Medicare taken out. So for a lot of companies, again, the best way, if you own your buildings, is own the buildings personally. Don't own them don't have the company own them. Because at that point, now the company can pay you rent for the building. Now, not a bad idea to have the building in a separate LLC because, again, that limits liability for you personally, right? Because, again, if you own it personally and something happens where the building burns down, right, suddenly everything you have personally becomes at risk. Whereas if it's in a separate LLC, it's insulated from you personally. Right. So again, I'll use my example here. Right. My landlord is the insurance agent that actually is in the other half of this building. I don't write out a monthly check to him. I write it out to a separate LLC that owns the building, and he happens to own that LLC. Right, so it insulates him, insulates the rest of his business from anything that might go wrong here in the building. So again, it just helps you from that standpoint. Now, incidentally, with those couple of items, a few other just ancillary things to bring up. Every time I talk about signing for your company, right? Or what the corporation is doing. You own the corporation. Make sure that you are signing, that every time you sign your name, your title is there as well. Because if you are signing on behalf of the corporation, then your title needs to be present. And a lot of company owners create this LLC, they have it in place, but at that point, Sam, I see your question. I'll get to it in a second. At that point, they sign their name personally, right? In other words, they just sign their name. They don't put their title with it. If you don't list your title when you sign, in effect, you are signing personally, and that's called piercing the veil. The veil of that isolation between you and the LLC. Right? And once you've done that, you've now opened up yourself personally to the liabilities of the company itself, which basically negates the purpose of having an LLC to begin with. And so that's one of those issues that certainly is there. You will run into that. So again, every time you sign, make sure your title is there and that's in place. So run by business out of a separate building, not part of the house. Is it better to pay rent or take square footage of the house? So the question at that point is, so it's a separate building, Sam, and that's all you do in that building is the company. Okay, so at that point, ask your accountant, but my recommendation would be to pay rent. Right? And the reason for that is because, again, you own that space personally. It's not in a separate LLC. So at that point, it starts to open up, if you were to sell that, any capital gains issues that start to create there. Whereas if you own it personally and the company pays you rent, now it's just rental income. You don't pay Social Security and Medicare on that rental income personally, and it's a deduction for the company. All right, and I should ask the question, that's assuming your company is set up as an LLC, and I believe for you it is. Okay, so at that point, it's a deduction. Rent at that point is a deduction for the company, and you only pay federal and state taxes. You don't pay Social Security and Medicare, so it can save you on that piece of the puzzle. Okay? Any other questions on this one? All right, so I hit signing, not piercing the veil. There was one other thought. That other question that does come up is, if I own my buildings personally and the company rents them back to me, just remember that as we start to get a little bit older, right, and I'm in that season of life a little bit, in that starting to look at what's next. Remember that in the succession process, if you're going to sell your company, everything is negotiable. Everything is negotiable, right? If your building that you're in is in a great location, well, that new owner might want to own the building. They might not want to give that up, right? And so just be prepared for that part of it. Now, that can also work to your advantage in that, okay, you're now retired. Do you really want to be a landlord? You got to make that decision for yourself personally. But along with that is, it's negotiable. A lot of people coming in today buying the company can't afford that outlay. So maybe what you do is you basically you give that individual a right of first refusal, right? Or so you sell them the company, they're going to lease the buildings back from you for X number of years. And then after X number of years, they'll buy the building. Right. And so that can actually help them get into buying it. If it's somebody that you know, a family member, an employee, something like that, it can help them with that dollar amount process. Certainly in this building, right? I've negotiated in my rent with the landlord right of first refusal to buy the building. If he ever wants to sell it, I at least have first shot at it. And so again, it gives that next business owner that possibility of being able to move forward. So hopefully those are a couple of things that helps you on that a little bit. Next one. Under depreciation, again, section 179 of the IRS tax code states that, again, you can take an immediate deduction for business expenses relating to depreciatable assets. Now, typically you're talking about cars, office equipment, business machinery, things like that. Now, here's the a part of that. For vehicles, right? So bigger things, right? So let me back up one step. So larger items, right? So as an example, in my case, The larger physical assets, our computer servers, our studio equipment, right? A lot of that stuff, those are depreciatable assets. We will have that on a separate asset list that we depreciate, we take the deduction for as we do those upgrades. And so we try and keep that up to date. We just went through an entire upgrade of the equipment in our studios here. I've actually, given all that information over to our accountants already, so they're prepared for it at the end of the year so we can take a write-off for that stuff. When it comes to vehicles, anything under 6,000 pounds is considered a passenger vehicle, and your first year deduction is limited to $12,200. If the vehicle is over 6,000 pounds, it's considered a commercial vehicle. And again, these are work vehicles only, so it's a company vehicle. At that point, the other limitation they put in, because if you remember a couple of years during COVID, they actually eliminated and changed this and they took it away and then they brought it back. And when they brought it back, there was another item in there. So, for example, it's work vehicles only. If it's a truck, a 6-foot cargo bed, not accessible by the driver, right? So the bed of the pickup, is there vans, right? We need to have the separation in there. At that point, it becomes that work vehicle. Again, we can now take the full write-off on that vehicle. Now, on your taxes, you can recognize the write-off the first year, but you're basically going to show that depreciation 20% per year over the next 5 years. If you sell the vehicle early, you need to in effect pay back the deduction that you took that very first year. Again, it applies to vehicles, equipment, software programs, any of that stuff that you're dealing with that are expensive. Certainly worth taking a look at and keeping that stuff separate. If you're of the age where you have children in the company, the IRS allows each child, any child under the age of 18, to earn up to $12,950. They only pay Social Security and Medicare. There's no federal tax on that. And you can pay them anything you want, right, per hour. So, for example, right, we had an example where there was a baby, was basically the model for the brochure, right? You can have them come in and sweep the shop floor. You can have them do, as long as they're doing some work, you end up at that point paying whatever you want per hour, right? And so at that point, you save the federal tax rate that they would normally pay on there, right? And so, again, an example of this might be, right, again, I'm going to have them come in and clean the shop floor. Right? Now, the IRS also says that as the parent or guardian of said young child under the age of 18, you have the ability to confiscate every single dollar that they earn, right? So you could, right, in effect, write a check to them for $5,000 for the work they're doing, turn around and pay them $10 an hour for whatever work they did, right? Or at least minimum wage in your state, depending on where you're at. And then you take and put the balance of that money into a college account for them, right? At that point, it gives you a way to save for college and you end up saving those federal taxes. So again, you can utilize that to your advantage for them. Now, when it comes to dealing with your income, be extremely aggressive on deductions. I'm going to take every possible deduction I can possibly take, but I want to report every single nickel that I earn. Right? Because think about it. What's the worst thing that happens if you take a deduction that you are not entitled to? Right? They slap your hand, make you pay it back with a little bit of a fine. If you don't report all of your income, that's when they come and get you with the silver bracelets. That's a federal offense, and that's going to be an issue, right? So, again, I'm going to be incredibly aggressive on the deductions, but I'm going to report every nickel that I earn along the way. Now, this does also bring up another issue that I'm going to talk about. And there's a couple of things that you need to know about Social Security. Now, there's also this whole discussion of whether it'll be there when you get there or not. Right? I'm running as fast as I can to get there to get something, right? So, but here's the thing. If you paid in Social Security, there's always this question of, how much will I get? Well, if you paid the maximum on Social Security, and what I mean by that is if you remember when you set up your company model in the software, remember we had the company matching taxes, and in there, we did this with your new company setup wizard, we put in, when you specified your state, it put in limits. So for Social Security, you had to pay the 6.2% up to a maximum limit. Right? And once your earnings hit that limit, you no longer had to pay Social Security. Right? So that was then dropped off, neither the company or you. And so if you hit that maximum any 8 times during your entire working career, right? Not just 8 times in a row, but any point in your career, then at that point, you're already at some of the highest maximum levels that you will possibly be at, right? And so, once you've hit that, then again, consider, dropping your salary down, changing more to dividends, and maybe maximize your spouse's income, right? Use that side of it. And again, how do you know if you've been there? Well, you can absolutely go out, and I've got the link right here, the SSA.gov. This is where this table is coming from. You go out to SSA.gov, and you go out there. It will show you what that maximum limit has been every single year that the IRS has had this in place, right? Going all the way back to 1937. Right? And so, and again, you look at those early years, those numbers were certainly a lot lower, right? And then all of a sudden it started ratcheting up a lot quicker. And in 2023, it was $160,200. I believe 2024 is $167,000. If at any 8 times in there you hit that maximum level with your earnings, you're already on the top end. Now, how do you remember what you made each year? And this is where some people get into trouble. You can log into, go out to SSA.gov, log into your account. All right, so there's an account out there for you. You need to validate that it's you, but you log into your account if you're not already there, and it will show you what your reported taxable income was every single year that you've worked. If that level is at or above these levels, well, then you hit that level at that particular year in your career. And so this is where, again, a lot of business owners, small business owners, get into trouble. And it's that they start looking at, okay, how am I going to get paid? Well, I just pull cash out of the company, right? Or something like that, which lowers my profit. Well, the end result is we had no reportable earnings at the end of the year, which means I didn't have to pay a whole lot in taxes, which also means you had no reportable earnings for Social Security, which means now when I retire, there's really nothing that it's going to pay out, right? Because your earnings were so low throughout the career. And so sometimes those things that we do earlier in our career end up hurting us when we get to retirement. So if that's the case, then hopefully you put monies aside for the retirement piece of the puzzle. So at least be aware of that one. Again, you can go out to SSA.gov and you can find a lot of this information. I've got this link in your book to go out to find this same chart. And then again, at SSA.gov, you can log into your own personal account and see where you are at. So again, once we've hit that 8th time, from the 9th time on, we're now maxed out at that point. One of the other items is, and really, quite frankly, a fallacy, is that on our tax returns, we're starting to get into that audit piece of the puzzle now. On our tax returns, that the IRS will compare this year's return to last year's return. So we don't want to make it look too different because suddenly then we have, that'll trigger an audit. Well, that's not true. Right. The IRS does not compare one year to the next for trends on a specific company. They've got over 280 million returns to look at every single year. That's not going to happen. They don't have the time to do it. They don't even have the time to process the returns. I mean, how long has it been for some companies? Some of you, quite frankly, are still waiting to hear about last year's returns. And so that winds up, that doesn't really happen. What is important, though, is that you just keep your books clean. The cleaner your books are, the less of a chance you ever have of seeing or getting an audit. Now, there are 3 different types of audits things that will trigger an audit, right? The first of those is what's called a compliance audit. Now, a compliance audit, years ago, for those of us who are a little bit later, we remember that every single year, the IRS would actually send us the tax returns that we needed to fill out, right? And they're going to send us whatever we sent last year. And they were even good enough to include an envelope to send those returns in that was already, addressed and pre-stamped and all the rest of that stuff that we could send it in. How nice of them, right? The problem was every one of those envelopes was already pre-coded for a compliance audit. 5 of them were going to be picked at random. Today, we don't get those forms anymore. We don't even get, we don't mail in returns. They're all done electronically today. And so the IRS literally at random picks 5% of the returns that come back for a compliance audit. And there's nothing you can do to get away from that one. If you get picked, you're going to get picked. Right now, that's one of the items that are certainly there. Again, if your books are clean, you're in good shape. The second one, and this is one that impacts many of us, is what's called the red flag system. Now, the red flag system basically says those areas of deductions that you take in your company fall into various categories, right? And they have a maximum for your type of company, for your SIC code. There's going to be, for that type of company, office supplies are typically no more than X% of your total revenue, right? And fuel costs for your truck are no more than X% of your total revenue, right? And they have all these categories with expenses. And what they do is they look at each one of these, and if an expense or a deduction that you're taking exceeds one of their percentage categories, that throws up a red flag. Now, if you get 1 or 2 of those red flags, they will typically send you a postcard, right, which basically says something on the order of, as we went through and reviewed your tax return, our numbers came up slightly different. According to our numbers, you would have paid an additional $94.38. Now, when most people get that card, right, because they also put on there, if you would like to send this in to us at this address, right? Vast majority of people will write out a check, run to the post office, mail it in because they don't want to mess with the IRS, right? Now, here's the thing. They are not saying you owe the money. They will gladly accept it if you mail it into them, but they're not saying you owe it. They're just saying their numbers came out different. Okay? And so make sure you're reading what you're receiving if you do indeed receive those. Now, if you actually get 7 to 8 of those flags that are tripped, that will trigger a full-fledged audit letter for you. All right? Now, what odds are today, what they're going to do is they're going to tell you what they want to look at. And if you would just go ahead and send it in to us, we'll review it and let you know what you come up with. You do not want to do that. If you're going to be audited, you want an in-person audit. You want to have the ability to have that conversation with them and talk to them. Because quite frankly, if you're going to send the information into them, then quite frankly, they're going to make whatever judgments and rulings that they want. And you don't have a whole lot to say about it. Right? I just went through an audit on our side about 2 years ago and had the same thing. I said, nope, I want an in-person audit. Right? They came in here, we scheduled a date. They told me what they wanted to have, so I had everything ready to go. We had the conference room table literally covered with stuff in the room next door, and it started to go through every single piece of it. And there were a number of items that we ended up having conversations over where they initially were going to rule that as that's not an allowable expense. And by the time we got done with it, they're going, okay, you're right. Right. And so, again, and I had the ability to take that time. Now, nobody likes an audit, right? But again, you'll like it even less if you don't have any input into the process. Now, the other thing that I will say about the audits is this, is if there's an audit, again, it all comes down to what do your books look like. If you're going to walk into the auditor's office with a shoebox full of receipts, it's not going to be a fun day for you, right? On the other hand, right, if your books are in order, if they're clean, you know the deductions you took and why you took them, you probably don't have a lot to worry about. I know just as many contractors that got involved in an audit and, they went in there, did the audit, and yep, they took deductions they weren't supposed to take, and they ended up having to pay it back and pay a fine to go with it and all that stuff. Then I know another whole group that they were even. You're right. Your books are good. We're comfortable with, with where you're at. and then another third of that group going, we actually found things that you should have taken that you didn't, and we owe you money. I know just as many that fall into all three categories. And one quick example, right? Again, it all comes down to how orderly are your books. One of our part-time trainers that we have online with us here now at Grandy, it was a master plumber, ran a fairly sizable plumbing and HVAC company for a number of decades. When he had his last audit, right? Again, they said, send in the information. He's going, nope, I want it in person. And literally, he showed up at the auditor's office, and he's rolling in with a hand cart with 4 boxes, banker boxes of information. And he's rolling, he's waiting at the elevator, and this guy walks in and looks at it, and he goes, are you my 9 o'clock? He goes, well, if you're looking for Rosga, then I guess I am. Right? And they went up the elevator, they go in, they threw all these banker boxes up on the conference room table, right? And literally what the guy did is he stopped and he just at random picked the box, pulled out a couple of sheets of paper, looked at those sheets, right? Validated them, went to another box, pulled out a little bit of information, validated, did it on the third box, and literally after 10 minutes he goes, okay, we're good here. Because he knew, based on his quick pick, that the couple of items he pulled at random were clean. He found nothing, and the odds of him finding something were pretty slim. Now, in our case, with today's books and things like that, we don't keep paper here anymore, right? With the accounting programs, every single receipt that we use is scanned in and attached to that particular expense in our accounting program. And so literally, if you need a receipt from me, I can get you a copy of the receipt in about 3 minutes. Because I can go into our accounting program for anything we've had in the last couple of years. Now, if you have that issue with getting receipts back, right? Because sometimes, we have somebody that goes out in the field, or one of our guys are in the field and they don't get the information back. One of the things you can do, today's world, there are a ton of these little apps, right, that you can use. We use one called Genius Scan. It's good. It works for both Android as well as the iPhones. And we do this all the time, because for me, that person that didn't get the receipts in was, I hate to say it, was me, right? Because I'd be gone on the road all week long. I'd eat lunch, right? I'd throw the receipt in my wallet. By the end of the week, it's either gone or it's all wrinkled up and folded and you can't read it anymore. And my bookkeeper hated that. And so finally, we just got to the point where we just got this little app. It's like $3. Put it on the phone. What our team does at this point is, when I eat lunch, first thing I do is grab my smartphone, take a picture of the receipt, I save it, it goes to a Dropbox here in the office, and my bookkeeper has it before I take the first bite of my sandwich. And now I don't have to worry about trying to keep track of receipts anymore. It makes life a lot easier for all of us, all the way around that one. So say I'm indicating you're having a hard time with bookkeepers. Is there better software than QuickBooks Online? What do you suggest? You know what? There are a ton of different softwares that are out there. It is interesting. QuickBooks is definitely trying to push everybody to the online version. I am not a fan of the online version at all. Right? I'm still one of those that hang in, and I've got my desktop version, and I just upgraded it again. However, in the next couple of years, they will be forcing everybody over to online. They're already doing it. It's kind of a hard sell on their part. It's definitely not as friendly as the online version. So part of that, then, which one do I recommend, really goes back to what you're doing in your company. Again, I'm still using QuickBooks today. You hear ads for some of these. If you're tired of QuickBooks, take a look at, FreshBooks is a one, but that's, might not be as friendly. NetSuite is another one, but NetSuite is unbelievably expensive as compared. And so, again, and the other problem with it, Sam, is that you get a lot of software programs that companies, that contractors are using in the field. They will manage everything, and then they feed into the backbone of QuickBooks. Right, so whether it's a Field Edge, a ServiceTitan, a lot of those the companies are feeding in. They're still using that as their backbone, and so because here's the problem: any of those other software companies that are trying to build that company management tool, it's very difficult for them to be experts at everything, right? They might be really good at dispatching and at maintaining my customer list, the CRM, and all the rest of that stuff, but they're not good at accounting, right? Or if they're really good at accounting, well, then they suck at the rest of the items, right? And so it's very difficult. I've not found somebody that's really good across the board. And so that's why more and more companies today are using QuickBooks as the backbone for the accounting side. They manage all the billing and all the other stuff out of their software tool, and then they use that as the actual accounting backbone on that side of it. And again, the online version, the plus of it is it's readily open to anybody who wants to interface with it. I mean, literally, we are in discussions right now with our planning for profit software to interface potentially with QuickBooks Online. And you can do it easily with online. You can't do it with desktop. So not a direct question or answer to that question. I don't know that there is one, because the minute I tell you, hey, here's the software to use, it's not going to work for your company like it does for mine. And that's the problem you run into. You got to find something that is going to work. So that's the second item, the second audit item. The third one is the economic reality test. Now, the economic reality test really doesn't apply to us too much, but it is one of the three things that will trigger an audit. And it basically says that you need to show that you earn enough money to support your lifestyle, right? They're looking for roughly a 5-to-1 ratio of income to mortgage interest, real estate taxes, and personal property tax. In effect, what they're saying is that if you are paying $250,000 a year in property taxes, you are not making $275,000 a year in wages, right? This is really something that applies to the ball players, the sports figures, the musicians, stuff like that are making all kinds of money. Yeah, they just need to show that they are making enough money to support their lifestyle. So chances are it doesn't impact you. If it does, I might want to be your new best friend. So from there is a couple of other things that are out there. So the IRS has their National Research Project, and it was under this area that, it was a couple of years ago, right? They hired 86,000 new IRS agents, right? Or they're working toward that one. A large chunk of that falls into this project, and it's basically what they're doing. It's a comprehensive audit that they will at random pick 2,000 small businesses each year, right? So it's targeted specifically at the small business sector, and it's with the goal of trying to make sure that how well are business and business owners complying with the employment and tax regulations. And really, they're doing this deep dive into companies looking at 4 different areas. The first one is worker classification. In other words, are your employees classified properly? Are they employees or are they independent contractors? Because a lot of companies, smaller ones, will say, yeah, well, they all work as independent contractors. They're all 1099 employees. Well, 1099 employee is not an employee, right? They're an independent contractor at that point, and we're saying that they need to, within their company, they're going to do all their withholding and file taxes and all the rest on that side of it. Here's the problem you run into, is on this one, the IRS makes it kind of difficult to have somebody truly as an independent contractor, because the questions are, for example, where do they get their jobs from, right? Are they working solely for you, or do they also do work for other companies? Now, if they're getting all of their work from you, they're probably an employee. They're not an independent contractor, right? And so that would be one. Another one would be, do they drive their own vehicle, or do you provide them with a vehicle? If you're providing with a vehicle, they're more than likely an employee. Where do they get the materials that they're installing? If you provide the materials for them, they're probably an employee, not an independent contractor, right? Another one would be, let's see, materials. Yeah, the big one is that, again, are they doing work for anybody else, or is it just you? Right. And again, they've got this whole list of questions. And I went through this with one of my team members. It's like 50 questions or 50 criteria that they have to meet to be considered an independent contractor. And sometimes there's not a lot of leeway. Now, if your team members if you're classifying them as independent contractors and they feel that no, they're employees, they will then go back. How long have they worked for you? And you will now have to pay all the company matching taxes going back to day number one and fines on top of that. All right. I'm working with a small business right now that had somewhere around $200,000 in back taxes and fines that they had to pay because their employees were classified as independent contractors and they were deemed not that they were actually employees. And many of them had been there for several years. And so this small company has for years been paying back on these loans, in effect, these forced loans from the IRS to pay back those fines. So that's the first one. Make sure your employees, if they are employees, make sure they're classified as employees. Next one is executive compensation, including salary, non-salary compensation, loans, deferred compensation, stock, all of that stuff. In other words, the monies that the executive team, the leadership team of your company is taking out, that it is all classified properly as income. So even if, for example, the company is, buying, paying some of your expenses, right, or something like that. We had a prime example, right? The company I used to work for, we used to do incentive trips for some of our clients, our contractor customers. And so I would go on that incentive trip with the contractors as an employee of the company. Now, the cost of my trip was an expense, right? Because we were chaperoning, if you will, or leading that incentive trip. My wife came with us. The value of her trip was income and was taxable, right? And if that's just flat out paid, she's not an employee of the company, that's extra income, right? That falls into this category. Or if the company were to give a loan to an executive of the company and is not charging interest for it, that would then be income, things like that. Fringe benefits, right? This one kind of ticks me off, right? I mean, years ago, I used to always have a stack of gift cards, right? And we'd hand them out to employees and, just as kind of perks and stuff like that. Well, technically today, that's income, and they want to see that we're paying matching taxes on that one. Along with that one would be Christmas bonuses, right? Might be an example. Right. So in my company, when we give out bonuses, let's say I'm going to give out a $500 bonus. In my mind, it's kind of neat for my employees to open up and see a flat $500 check. Right. Instead of the gross pay was $500, and then we deducted all the taxes on it. Right. And then we ended up with a net check of $420. Right. And so literally in that case, you can do two different things. I've had some years where I would tell my payroll company to actually net up the check. So again, I want the net amount of the check to be, or gross up the check rather, I want the net amount to be $500. They will then figure out backwards, okay, what does the gross amount have to be so we're getting payroll taxes out of that? Because again, IRS has got a problem with that. Or I've had other years where quite honestly, I took the funds out personally as distributions and then paid that, which meant in effect, I'm paying the taxes on it and the employees now. So they're looking at those kinds of things. And then again, payroll taxes, that's your 941 forms, your 1099 forms, W-2s. Are they accurate? Are they being filed on time? Things like that. So that's a chunk of this piece of the program. Keep this stuff clean so you don't run into problems moving forward. And then, so I'm curious, right? So these are just a number of items. Are there other legal things that you've done to reduce your taxes? Right, there's a whole bunch of illegal things that people have done, right? But, if you've got some of these, go ahead and throw them in the chat box. One of the other things that, again, and we brought this one up certainly in the workshops, is that many times we get to the end of the year and the accountant's going, man, you're having a great year. You need to go spend some money. You're going to get nailed with taxes, right? And we'd see contractors all the time, right? All these brand new shiny red pickup trucks backing up to the loading dock. Well, yeah, that does reduce the taxes because I can take a write-off. But the question is, did I really need a new truck? Right? Now, if you needed a new truck, go get a new truck. That makes sense. But if you don't need one, are there other things that you can do? Right? So, for example, you might prepay on inventory that you're buying for a job that you know you're going to be doing in the next month or two. You might prepay expenses for next year. So, for example, in our case, the Zoom platform that we use to do this program, it's an expensive tool to do it at the level that we do it at. If we can, we will pay the entire year of 2025 in December of this year, because now I can take the entire write-off for that cost this year, and yet it helps my cash flow for next year because now I don't incur that monthly expense. Right? So you can certainly look at that one. So go to trade shows, make sure that that they're near someone that you know who's, yeah, absolutely, right? So then the visiting family suddenly is a write-off the expense, right? I did that last week. I was in Miami for some training and a trade show. My brother lives 20 minutes away. My brother and I got together for dinner. It was great to be able to see him because I don't see him more than a time or two a year. It works out great. Right. In a couple of weeks, I've got another class in Indianapolis. I've got an uncle in Indianapolis. I get together with him every time I go. Great way to do that, right? It's a write-off for that expense to be able to do that. When we talk about prepaying some of those expenses, one thing you can't do, because I get asked about this one all the time, is what about if I prepay rent for the building for next year? Well, that you can't do. IRS says that rent or those type of expenses can only be incurred for the period of time that you were actually in the space. And I haven't been in this space next June yet, right? That's in the road, so I can't take that as a prepaid expense. But there are a number of other ones that you can take. And so I want to hit this last item here. We're up at an hour at this point, so just a couple of minutes left here. I also get the question of, okay, how do I pay down debt, right? Because a lot of companies will go ahead and, oh, there you go. Right. Golf memberships for clients to build rapport. Absolutely. Right. That would, because that falls into the category of really client gifts or customer gifts. Right. So that would definitely be deductible. We could do that. That's a good one. So what are the others? Okay. So you wrap the boat. Sure. Right. Because now all of a sudden, right, especially if that's an expense that you're using for serving clients on the lake. Yeah. Without a doubt, I would do that because that's an advertising expense or a marketing expense. So one of the other items is a lot of people, especially if they're debt averse, say, okay, I'm working on paying down debt, right? So we're working in that direction. Well, they get extra cash, they pay down debt, and then when they get to the end of the year, they're short of money. Because again, if you remember, we talked about this in the workshop, that again, that difference between cash flow and accounting, your P&L will lie to you every day. Right. So if I have this company doing $800,000 in total revenue and I subtract all my expenses and my P&L tells me I made $14,000. And then I look at this same company from a cash flow perspective, same sales, same cost of materials, same cost of overhead. But instead of $20,000 in depreciation, our actual equipment replacement costs, that's a cash flow thing, was $35,000. And instead of $6,000 interest on these loans that I got, my actual loan payment was $24,000, and then all other overhead costs combined are exactly the same. I do the math on this exact same company from a cash perspective. I actually lost $19,000, not made $14,000. But the problem is Uncle Sam's going to come back to you and go, hey, way to go. You get to pay taxes on $14,000, even though you're already overdrawn. And so that's where this piece of the puzzle comes in. People try and pay off those, cash. They put more cash on the principal, and then they run out of money when it comes time to pay taxes, right? And so this is literally what we did here at Grandy and Associates. We actually go through every month, right? So this is my very simplified P&L, right? This month I had $159,000 in income. We had $91,000 expenses. We had $68,000 in profit. Now these aren't my numbers, right? But it's an example, right? So this is an accounting profit. It's not my cash flow, right? So in my case, I know we got equipment replacement costs. We talked about that. So for me, that's $1,500 a month. I'm putting that in my equipment replacement fund. I'm paying down on my line of credit, so that's another $3,000 that's going. I've got a loan out there. Now, the interest on the loan showed up on the P&L in my expenses here, but all the principal I paid is not. So I'm going to factor that in, right? And then I'm going to put another $1,500 into what I'm calling the Hill and Valley account. Just an account to save money for those negative months that I'm going to run into throughout the course of the year. So I tally that up. That's another $8,400 in expenses that don't show up on my P&L. So when I subtract it out, my actual cash flow profit for the month was $59,000, not $68,000. So then the question is, what do I do with that profit? And this is how I handle it. This is how I literally took care of my company, and I have a bunch of companies doing the same thing. So the first thing I do is I know without a question of a doubt, if we made money in a month, it wasn't purely because of what I did. It's because of the work of every single person on my team. And so if I made money, I will take 5% of that cash flow net profit. So I'm going to adjust it for cash flow, and I'm going to give that back to the team. And you can set up your profit sharing pool however you want. I've got an example that I'll show you here in a minute. So 5% is going to go back to the team. And then of the remaining, I'm going to take 40% of that and I'm going to apply it to debt reduction. Right? So we start to pay down that debt. And then the remaining another 40% will go into my Hill and Valley account. Now, I already put $1,500 in there, but if I had profit, I'm going to put another whole chunk in there. I'm going to start building that account up. And then the remaining 15% of the profit just stays in the checkbook for operations. Right? Now, let me go back to this one here. I thought I had an example. In this one, I don't. In your book, I believe we do. So what I'll do with this 5% pool, I'm not one that wants to sit here every single month and say, okay, now how much am I going to pay to Joe and how much am I going to pay to Sean? I don't want to do that. I come up with this 5% number. I have a spreadsheet which just simply says I've decided what percentage of that pool every single person in my company is going to get. Right? And so all I got to do is plug in $29.76 and it spreads it out this way amongst my team members. That goes over to payroll and I'm done. All right, I don't have to think about it. It happens very quickly. Not everybody has to be at the same level. For some companies I know, they do that just for their leadership team. Others do it across the board. Not my case. I do it for every single employee in the company. And so that can help with that piece of the puzzle. So that's a good way that you can do that. That way you've got the money there. You're paying down debt when you have the profit, but you still have money that you're putting aside for taxes and for those negative months when they do happen to be able to maintain your cash flow. So hopefully that one will help. If you want more information on that piece of the puzzle, I know during the workshop, we gave everybody access to our Contractor Academy to one particular lesson called our Monthly Money Matters. If you want to go back and revisit that, Contractor Academy is $29 a month per person. That's it. And right now, if you were to attend, there's about 70 hours of training content out there. And again, you have access to all of it, including that Money Managed program. Literally just this morning, I finished recording the final lesson of a 45 lesson series that we're doing on HVAC basics. And so that one is out there as well. So that's in place. The other thing I do want to point out is, again, we want you to be able to work toward a point of being debt-free. How much is the debt that you're carrying in the company impacting your profitability? And so one of the things that we added into the software is a new cost input category for debt. And this is active today. And just to give you a sneak peek of what that looks like, I'm literally only going to spend a minute and show you where it's at. If I go into the software, whoops. So I'm going to log into my account just to show you where this is at. So right now, under cost input, we've got the new section in here for debt. Now, before any of your debt, you actually put in under fixed overhead expense. And so it just kind of got buried there. We really didn't see it. Now we've got this debt category. You're going to enter it exactly the same. So your line of credit, any loans that you might have can be moved to this category. In this example, I've got a past due balance with my supplier. So I'm going to put that in there so I can make sure my pricing is set to be able to pay that back. I got a truck loan in there. And so all told, in my case, I've got a grand total of $221,000 in debts that I have in the company. Now, once I enter this in, the nice part about it is I can now go into my reports, and when I look, for example, at my profit statement, it will now break out. So we've got all of our variable expenses. Right, we've got those here. That's cost of sales, variable expenses. We have fixed expenses underneath that. So all the rest of the stuff that we put in. And now you can actually see a breakdown. Here's all of my debt and how it's impacting my three departments. How I have it allocated, because you're going to allocate it the same way. And then ultimately, that also brings you back when you're in your labor rate analysis report. I can look at my install department, and I can go to the labor rate breakdown, and I can now see how much that debt is impacting this department. So in this particular case, I've got this, each loan is there, and I can see $9.99 out of this department, out of every hour I bill out in this department, is just going to pay down debt. That's it. And so if I could actually eliminate that debt, my profit would go up basically $10 an hour. And that's in one department. Right. So that's live. It's in there at this point in time. Again, if you've got your model that was built and you want us to move your debt items over, if they're clearly, clear in your fixed overhead, let us know. We'd be glad to do that for you. You only have to do it once, and then you're good to go. So with that, that does bring us to the end of what we have of this particular live classroom. If there are any other questions, we'll hang here for just a moment. You can throw those in the chat box. Otherwise, we will send you the link for this as soon as we get it rendered and turned around. You can look for that in your mailbox. So with that, guys, it's been great having you here. Make a decision to make it a profitable day.